Pound yen. As an entry here. I think the market's oversold. No, it's got to be 15. It's too many ticks off. It wouldn't have fired an alert. This would have been, but right into market profile again. You can see how market profile held up price here. And here's the signal right there. Let me see if that goes into market profile. That may go into market profile as well. It does. So you'd have to stand off that signal. And that's an oversold signal. All of them. Just like we couldn't take the other one, the winner. We escaped these losers because the MA diff is too big. Pound New Zealand. See, this one's more discretionary because the candle's pushing through market profile. Just hasn't been much on any of these charts right here. And you can see there's a winner. For 11. This one's overbought, and this candle's floating way off of the 15. And this is a great signal, but it just doesn't come on the appropriate background color. Same here. Wrong background color. Not a lot of movement on any of these markets today. Pound USD, nothing. Pound dollar, too far off of resistance. Euro dollar, hardly any candles since midnight. Euro pound, also hardly any candles since midnight. Euro yen, just a few candles since midnight. Dollar yen, very few candles. And the Aussie dollar, again, here's the session. Very little. Just not much there. See, we're going to get entry, Doc, on a sell and a down close here. no follow through. Overbought. We won't get a long signal here because the 15 is below the 50. The algorithmic system programmed into the dashboard will only allow a long trade when the 15 is on the same side of the 50 as your trade. Didn't come with a dot. No alert. No, we'll get entry dots sometimes pointing us in the wrong direction, but they'll never come with an alert. Or the alert's coming with the potential that the candle's going to push to the downside. No, I don't think we're going to get an entry dot here. If we get a pull up, an up close on this candle, and then a subsequent down close, I think we'll have an entry. We're not chasing much volume across the board. I just know alerts across the board. Again, very little movement. Let's take a look at D. Again, very, very slow movement. It's overbought. All these signals are all overbought signals. Just no, just very little lack of movement. No chance for an entry on the pound dollar. See, here was a perfect entry right into the value area low. And we saw multiple entries that would have been losers if we didn't respect the value area low. So if we're going to avoid those losers, once in a while we're going to have to give up a winner. Day trading is never about the number of winners. It's always about the number of losers. You avoid the losers, you become a profitable day trader. 15 is I wish there was more to show. This has been sitting here since 8:02. Not a candle. I'm 7:52. 11 minutes. No candle. Nice signal, but no alert. Since the market's moving so slow, let's define what we need in order to get an alert like this. And you'll get a little bit of better sense of what the algorithm is, and also have a little bit of a better opportunity to anticipate when you're going to get an entry dot. Now the first thing, I'm going to watch the dashboard as we talk. First thing is you're going to need either dark pink background bias, or you're going to need this green background bias. This tells us our two higher time frames on a range chart are the two higher fib numbers. The two higher fib numbers are an 8 range and a 13 range. And that color tells us that all support to the downside is broken. Our 15 has crossed the 50 to the downside, and the 15 and the 50 are red. That's a lot. So on the 8 and 13 range, without you having to look at it, this can be applied to any market, any time frame. The speed of your trading chart determines the two higher time frames. If you're trading, say, 3-minute bars, your next higher time frame is going to be a 9-minute. Your next higher time frame is going to be a 27-minute. If you're trading a 377 tick, your next higher time frame will be the two higher fib numbers. And if you don't trade a fib number, it will default to the closest fib number, and then extrapolate the two higher time frames from those numbers. So let's say you're trading a 7 range. It'll default to an 8 range and calculate the two higher time frames as a 13 range and a 21 range. So your trading chart doesn't have to be a fib number. The indicator itself will default to the closest fib number to give you the two higher time frames. Same thing with a Renko, and same thing with a well, with time it's easy. It's just going to give you 3 times your trading chart, and then 3 times your next chart. We want to always trade on the same side as the modified 15. So the 15 must have crossed the 50 to the downside, and the 50 must be red, and the 15 must be red. So it's very, very strict criteria. Now our other colors signify weaker areas of either down movement or up movement, but they still tell you that the markets are correlating to the downside or to the upside. So the only difference between the dark pink and the teal color here is that here you've got support to the downside broken. The 15 and the 50 are red, but the 15 has not crossed the 50, has not crossed the 50 to the downside yet. And we consider that to be a very important signal and increasing the probability of a win. When you trade on, it's almost like a MACD crossover. We want that faster time frame to have crossed the slower to the downside. And in 2 years of forward testing, where we do market replay data, it really adds significantly to the positive predictive value of an entry. So that's entry criteria number one. Entry criteria number two is the distance of the candle from resistance on a short trade or support on an up trade. And I'll give you an example. Let's say that this background bias was dark pink. The system looks at the distance between resistance and candle open. Oops, wrong, sorry. That's 5 ticks. The system is only going to allow, I can't remember if it's 2 ticks or 3 ticks, but we want the candle open to be tight to resistance and tight to support so that you don't get, after the entry, a retracement back to resistance, up to resistance, or down to support, get stopped out, and then the trade continue in your direction. Like that. Then we believe that the market overbought, oversold is not based on any oscillator, and in 2 years of forward testing, we have now found any oscillator to have any predictive value in terms of overbought, oversold signals. They do not in any way increase the positive predictive value or success of your trading. If you go short on an overbought signal, or long on an oversold signal, or you take stochastic divergence, you're going to get run over multiple times. So what we did was we looked for a more definitive way of determining overbought, oversold, and what we found was that as the space between the 50 and the 15 begin to widen, the market becomes obviously more and more sold, and when this space is 15 pips or greater, we consider that market to be officially oversold or overbought. Now, it doesn't mean if you're trading the system on a discretionary basis, you can't take a trade with the MA diff, and the MA diff just stands for moving average differential. It's in 16 pips. You just know that if it's greater than 15 pips, you start to accumulate additional risk. If you believe the risk is worth it because all the other independent variables align and it's a great trade, you can take the trade. But you understand that the risk you take it with is slightly greater. And that's the same thing with an MA diff of 17, 18, 19. Understand if you take the trade, you're going to accumulate more risk. The other is the quant line. We want that to be red. And the quant line looks at correlative markets. Now, when the Euro USD goes down, and it's really a great marker of money flow. When the Euro USD goes down, there are 3 markets in the quant line. There are and those markets must correlate with the direction of the Euro USD by 0.7. So it's called the correlation coefficient. And the correlation coefficient must be 0.7 You can define a correlation coefficient at whatever you like, but 0.7 is the standard. This means that there are certain markets that go down when the Euro USD goes down, and certain markets that go up when the Euro USD goes down, with a correlation coefficient of 0.7 or 70% of the time or greater. So really what we have to look at the Forex market is simply the rotation of institutional money across multiple Forex pairs. When institutional money believes that it's most advantageous to move into the Euro USD, they're going to pull money out of certain markets that they feel it's disadvantageous to be in. And there's a correlation between that with three markets. And it took us a long, long time to find those markets, but the correlation is very strong. You can see that the market, and it's just notable and important for you to understand, that the line doesn't turn red because price falls. This indicator is not using any data from the price chart. It's using data from three other instruments. So you can see how well the quant line correlates with the direction in predicting future price movement on the Euro USD. This is telling us that money is flowing out of the Euro USD and into the other markets that are going to go up when the Euro USD falls. And you can see, as long as the quant line is red, there's a strong down bias. Now, it doesn't give you an entry, but what it gives you is a strong bias. You're not going to take a long trade on a red quant. So what it does is it increases the predictive value of a short entry. So that's another independent variable that we look at. And really the key to the indicator system is that we don't use none of the important dependent variables or keys to predicting future price movement use price movement from the trading chart. The bias uses the two higher time frames, and the quant line uses three other correlative markets. So that's what makes them independent variables. And that's really important. Anything that's linked, any indicator that's linked to price movement on your chart is a dependent variable. If price goes down, the oscillator falls. If price goes down, your MACD crosses over. So they become dependent variables, and they can in no way predict future price movement. We've looked at the utility of the oscillator and MACD, simply looking at data from the trading chart, and over a 2-year period, they cannot predict future price movement. So they're useless. I mean, the traditional indicators that are looked at to trade don't work, and that's why 95% of day traders, swing traders go broke. They're looking at indicators with no ability to predict future price movement. These indicators, because they use multiple higher time frames or multiple other markets and don't look at price on the trading chart, are true independent variables and can predict future price movement. Look how the quant line tells you its prediction for future price movement. Right now, because it's yellow, the correlative markets are moving in all different directions, it's predicting chop. And going to look at that trade. Now, unfortunately, we have market profile, and we don't trade into it because it's a strong area. The value area low can act as a strong area of resistance or a strong area of support. But we know there are a huge number of buyers and sellers sitting at the value area low, value area high, and point of control. We avoid those because they decrease the predictive value of the trade. Now, market profile is also assimilating data from multiple time frames, but it's looking backwards. It can't look forward, and it can't look at higher time frames. So what it does is it uses data from a look-back period to anchor it and give it stability and provide it with true validity. And you see how many trades that we saw this morning bounce off that value area low. And without market profile, we would have taken the entry and had a loss. So market profile helps us immeasurably. Then the only other thing I wanted to mention, and I know it's heretical to say it, and that is the Fibonacci myth. I'll just shorten it to the Fib myth. I don't know who's in the room, and I don't know. I've disseminated this information in webinars in the past. But what people do is they assume that what other people have told them is accurate, right? And that's why each generation of day trader continues to fail. I mean, why isn't the fact that all you there who are learning information from the generation of day trader, from the last generation, who's learned from the generation before that and the generation before that, and considering that there may be a generation every 2 or 3 months injected into the market, just a new set of traders, why don't we continually improve the track record of day traders overall? Why does that 95% failure rate remain stagnant and not improve? Why is it that nobody learns from anybody else? And that is because we all accept as being true simply what we're told as being true, and we don't ask for proof. I mean, people are handed an oscillator, and they're told it works, and so they accept it. People are handed a MACD, and they consider it to work simply because they're told that it works. They don't ask for proof. And really, all it becomes an old wives' tale that everybody accepts as being true. The fact is, the oscillator, looking at price from your trading chart, has no future predictive value. I mean, a lot of people tell you that indicators don't work. Well, they're right and they're wrong. The indicators that we use don't work, for sure. And that's because the indicators don't understand price action and market structure, and don't understand that you can't simply look at price from your trading chart in order to determine future price or predict the direction of the market. And the Fib myth is that Fibonacci works, and it absolutely doesn't. I mean, we looked at Fib retracements and extensions over a 2-year period, and whether or not a Fib level is actually over a 2-year period, about 46% of Fib levels will hold. It's about 50%. So what you got is a 50-50 shot of having a Fib level. Oops, don't want to do that. Break or hold. So what good is it? And the value of it is 0. And Fibonacci numbers were created by a very, very early mathematician, I believe in the 17th century, maybe the 18th. I just don't know for sure. And they do very, very little in nature. They describe the edges of a snowflake. They describe the number of ridges on a pine cone. But they don't describe the movement of particles in a closed system. And what the stock market is a closed system. And what we have to look at is what are the independent variables that describe the movement of the particles or components of this closed system. And the fibs do nothing to describe the behavior of price in this closed system. They were never intended to, and they don't. Only some bright guy, I don't know, 100 years ago, 75 years ago, I don't know when it was, decided that he would apply fib math to the movement of price in the stock market. Never did a dogmatic assessment, a mathematical assessment to prove his thesis. A lot of people accept it as true, and I don't think you can ever show me one Fibonacci believer, and they adhere to it fervently, that it works, and people consider it to be like magic. You mention fibs and everybody runs because it just has this this aura and myth of I don't know, it's like a sexy indicator. But it's never been shown to work, and we've proven that it doesn't work. And why should it work? I mean, it was created 150 years before the stock market was invented, I think. So, or maybe 100 years. I don't know. It doesn't make any difference. It was never meant to be applied to the movement of the stock market. Now, Gann theory and Elliott wave theory were. But they are absolutely nuts. And no one's ever made money off of Gann theory or Elliott wave. I mean, they provide elegant rationale for why they believe that they do describe the movement of price, which kudos to them for that at least, but they don't work. I mean, no one's been able to get a five-way, to determine a five-wave Elliott move on the market. Looks great in a textbook, but it doesn't have any value, a practical value when you're trying to day trade a currency cross on the Forex market. It just doesn't have any. So, and then some other bright idea guy. Now there's Ganacci. He's combined Elliott wave and Gann theory, or Gann theory and Elliott wave, and he's got the Ganacci theory, which is a bunch of garbagiola, because he doesn't provide you with the mathematical statistics to show that it has scientific validity. And what we're doing is this is a science. This isn't an art. I mean, we're not painting, creating statues. This is like architecture. I mean, if you don't erect a building using sound mathematical principles, it may look great and beautiful when it's going up, but 2 years later it's going to fall and collapse because all the stress values and the mathematical values that you need to create that infrastructure not being taken into account are going to cause it to come down on your head. This is why so many day traders fail, and it's what makes the dashboard so powerful. The only independent variable that we cannot control for and can never be controlled for is volume. And that's why we created the indicator in the lower left. It shows volume. And volume is really low. We're just not going to get entries. And if an entry comes on low volume, it doesn't have very much predictive value. And that's just the way it is, because everything that we see in the market all based on sentiment. And when only a few people carry that sentiment, it's subject to abrupt change. So we can monitor it and understand that, and make sure that we take it into account, but we can't control it. And it's sort of a little bit of the loose cannon, but it isn't loose as long as we watch. And if we take a trade in a slow, lackadaisical market, we markedly increase the chances of taking a loser. The predictive value of an entry drops off markedly. So the whole system is based on sound mathematical principles that have been tested and shown to work. Unlike all this junk, Gann theory, Elliott wave, Ganassi nonsense, oscillator MACD, and we looked at the MACD on multiple time frames, projected onto your trading chart, and the MACD crossover just simply doesn't work. The oscillator will not get you an entry. It can stay overbought forever. It can stay oversold forever. And if you look for a divergence signal on an oscillator, whether it's stochastic or relative strength, or the CCI or the Williams K, and there are people selling the Williams K indicator and actually charge you for it when it's an open source. They're all oscillators. They all assimilate. They all look at the same formula. Only each one looks at it slightly different. And they all use the same four numbers: the high of a candle, the low of a candle, the open of a candle, and the close of a candle. And they look at the relation of the high, the close to the high, and the relation of the open to the low. They all crunch those numbers slightly differently. That's all. That's the only difference between RSI, between the CCI, between fast stochastic and slow stochastic, and between Williams K. They look slightly differently at the relationship between the open and the high, and the close and the low. That's all. So no individual stochastic indicator has any more validity than the other. So listen, we're going to have to stop today due to an absence of volume and an absence of traders. I mean, we just don't have traders today. And it's really a bad time right now because we're going into the end of August. And it is the slowest time in the market that there is. We still don't have the, this is when most of the institutional guys are gone all over the world. Everyone takes their vacation right before the September school starts everywhere in the world, except if you're in a different, except if you're in a different time zone or in a different hemisphere. But the majority of volume comes from Europe and the United States, and I know that Asia contributes significant amount, but still, the U.S. and Europe, I think, are the 1 and 2 contributors to volume, and you know, we have the same summer, winter, fall, and spring, and we are now going into fall, and volume will pick up markedly as August ends and September begins. So we're trying to trade right now, really the toughest period of time. But I just wanted to give you a little background while we just sit here and watch these markets, and we don't have to sit and twiddle our thumbs, and give you a little rationale for how the dashboard works. That's a 2-tiered system, and it's really designed to give you great entries. You have to avoid the pivots, unbroken moving averages, and market profile. And if you do, you're going to get great entries. We just need volume. That's why we look at 10 Forex pairs. We're going to get multiple entries as we move into the fall on a single day. In fact, we're going to get so much movement. My concern is that we're going to get 2, 3, and 4 entries at the same time. and we're going to have to pick one at random, open it, and trade it. It's really impossible to trade two markets at once. So listen, everyone, have a really, really nice morning. We'll see you back here tomorrow, and hopefully we'll see you in the futures trading room. It's been hard there, too. Yesterday we made $300 in the futures trading room. The algorithmic system made money, but volume there is also really terrible. It's very slow and very, very difficult to trade. So have a great morning, and we'll see you tomorrow. Bye-bye.